BlackRock is quietly seizing control of the world's most critical systems, and remarkably few are stepping in to challenge their dominance. This isn't a rehash of the usual surface-level stories about the company. By now, the broad public outline is familiar. BlackRock stands as one of the most formidable financial powers on Earth, wielding such immense sway that it can bend governments, corporations, and entire markets to its will. Larry Fink, the driving force behind BlackRock, exerts influence so profound across every major sector that some observers half-jokingly call him the true power behind the throne in Washington. Yet his ambitions have evolved far beyond merely owning stakes in companies. He is methodically capturing the essential arteries of the global economy itself. With a calculated strategy projected to involve trillions in infrastructure plays, Larry Fink is advancing his vision, and at present, no significant force appears capable of halting this momentum. The shadowy extent of BlackRock's behind-the-scenes authority is truly without parallel in modern finance, and it raises serious concerns about whose interests are truly being served. This perspective comes in part from Tariq Fancy, who served as BlackRock's inaugural chief investment officer for sustainable investing before stepping away and becoming a vocal critic of certain industry practices. In exclusive discussions, he has shed light on the inner workings of this enigmatic giant. To further decode BlackRock's evolving strategy, insights come from experts like Dr. Thomas Merwa, a specialist in public banking and infrastructure financing, who highlights the broader implications of such concentrated private control over public essentials. Consider the historic scale. The United States once invested unprecedented sums and sacrificed tens of thousands of lives to construct the Panama Canal, a marvel of engineering that reshaped global trade. Recently, amid renewed focus on national sovereignty, discussions have swirled around reclaiming influence over this vital waterway. In a major development, BlackRock orchestrated a multi-billion-dollar agreement to place key ports on both ends of the Panama Canal under American-aligned control, aligning with broader geopolitical shifts. While headlines fixate on political rhetoric and America First themes, the deeper reality often escapes notice. This move transcends simple trade policy. It's a fragment of an expansive, intricate chessboard where airports, energy pipelines, electricity grids, data highways, and other foundational networks are the true prizes. Larry Fink is steadily acquiring positions across this vast landscape, positioning BlackRock to oversee the indispensable lifelines of modern society. To grasp the roots of this sweeping ambition, we must travel back to the late 1960s. In an era when most California teenagers were pursuing dreams of rebellion, self-discovery, or simple escape, young Larry Fink stood apart. The son of a modest shoemaker, he harbored an unusually intense drive, a relentless question of how someone from ordinary origins could ascend to command influence comparable to that of presidents, titans of industry, and royalty. From an early age, his ambition was palpable. He craved more than circumstances seemed to allow. Politics appeared the conventional route to power, so at 17 he entered UCLA to study political science. But a seemingly minor decision altered his trajectory forever. On a whim, he added courses in real estate. The allure of towering buildings, vast fortunes, and tangible assets quickly overshadowed any White House fantasies. After earning an MBA with a focus on real estate, he still lacked a precise blueprint for turning vision into empire, yet the core objective endured: unyielding power coupled with immense wealth. Like many ambitious finance graduates, he gravitated toward Wall Street, the arena where outsized egos and bolder risks often propel the boldest to the summit. Arriving on Wall Street in 1976 at age 24, Larry joined First Boston's bond trading desk. As a young Jewish trader in that era, he navigated familiar prejudices, but Wall Street's overriding creed remained absolute: profit trumps all else. Success washed away distinctions, and Larry discovered his true element. He rapidly generated millions through innovation in an under-the-radar financial instrument: mortgage-backed securities. These securities essentially bundle home loans into tradable packages, slicing and selling them to investors seeking diversified, steady returns. When homeowners make payments, profits flow reliably, monetizing the American dream in fixed income form. Though the concept carried inherent dangers if too many underlying loans soured, it exploded in popularity during the 1980s. Larry didn't merely participate. He pioneered, popularized, and profited enormously from these instruments, rising meteorically to become the youngest managing director in First Boston's history within just 2 years. Whispers circulated that he was on track for CEO. Success, however, bred overconfidence. Colleagues later recalled moments of abrasive arrogance. To lock in his ascent, He wagered aggressively on Federal Reserve interest rate movements, positioning the firm accordingly while hedging against error. When rates plunged instead of rising, a critical miscalculation in the hedge formula exposed the firm to massive losses. $100 million vanished in a flash. Despite his prior billions in contributions, the blunder turned him into a pariah. Hallways emptied as people avoided him. Soon after, he was out of a job. The episode taught a brutal lesson. Unchecked risk, while intoxicating and often rewarding, can destroy even the most talented. From that point, Larry vowed mastery over risk rather than servitude to it, a shift that would become the cornerstone of his future empire. Rebuilding demanded an exceptional team and capital. Undeterred by his tarnished reputation, he assembled an elite group of 8 top traders. Funding arrived through an alliance with Stephen Schwarzman of Blackstone, who invested $5 million for a 50% stake. In 1988, BlackRock was born. From day one, the firm differentiated itself by embedding sophisticated risk management at its core, rather than treating it as an afterthought. The pitch was straightforward: entrust us with your fixed-income assets and receive cutting-edge risk analytics alongside management, all for a fee tied to assets under management. This integrated approach resonated immediately. Profits surged, and within a year, they oversaw nearly $3 billion, an astonishing feat for such a young entity. The true engine of this ascent was Aladdin, BlackRock's proprietary computerized platform, short for Asset, Liability, Debt, and Derivative Investment Network. Far more than software, Aladdin functioned as the firm's central nervous system, enabling instantaneous modeling of countless scenarios: interest rate shifts, mortgage defaults, market shocks. For institutions navigating uncertainty, it proved invaluable. Its value shone during the 1994 bond market rout, where BlackRock emerged relatively unscathed thanks to refined models, while rivals bled heavily. Clients recognized this wasn't fortune, it was foresight. The pattern solidified. In chaos, summon BlackRock. Tensions eventually arose with Schwarzman over equity distribution for talent. By 1994, with over $50 billion under management, the partnership fractured. Schwarzman retained Blackstone. Fink claimed full stewardship of BlackRock. Going public in 1999 accelerated expansion, and Aladdin evolved into an industry-wide powerhouse, licensed to competitors for substantial fees, generating revenue even from rivals. The 2008 financial crisis delivered BlackRock's defining moment. Having learned from past MBS pitfalls, BlackRock limited exposure while others gorged recklessly. As Bear Stearns cratered and Lehman collapsed, panic engulfed markets. BlackRock seized opportunities, notably acquiring Barclays Global Investors, including the iShares ETF empire, for $13.5 billion in a distressed sale. This catapulted BlackRock to the world's largest asset manager, dominating passive ETFs that now hold significant stakes in virtually every major corporation. Though classified as passive, these holdings confer substantial voting influence over executive compensation, board policies, layoffs, and more, without the regulatory burdens of active owners. During the meltdown, the Federal Reserve, desperate to stabilize toxic assets, repeatedly turned to BlackRock for expertise. Larry's team essentially drafted rescue blueprints, valuing troubled portfolios and advising on bailouts. From crisis emerged unparalleled connections in Washington and a reinforced reputation as the go-to crisis manager. Post-crisis reforms like Dodd-Frank targeted too-big-to-fail banks with stringent oversight. Yet BlackRock deftly avoided such designation through aggressive lobbying, strategic meetings, including with President Obama, and arguments that its asset management model posed no systemic threat. The passive investor label further shielded vast holdings from scrutiny. Meanwhile, the revolving door spun relentlessly. Dozens of BlackRock alumni cycled into Treasury, Fed, SEC roles, and vice versa, embedding influence across U.S. and global institutions. Aladdin's dominance deepened. By recent years, it oversaw roughly 10% of global financial assets, relied upon by central banks and pensions alike. In 2020's COVID turmoil, the Fed outsourced massive bond purchases to BlackRock. Such dependency prompts unease. If Aladdin falters, or if insights are leveraged privately, who holds accountability? Larry Fink's push into ESG, environmental, social, governance, initially rebranded BlackRock as a forward-thinking leader. He proclaimed forcing positive corporate behaviors through investment decisions. Yet critics, including former insiders like Tariq Fancy, exposed it as largely fee-driven marketing, repackaging standard products as green to justify premium charges amid fee compression. Backlash intensified. Conservatives decried woke capitalism, states divested billions, and figures like Chamath Palihapitiya called it fraudulent. By 2023 to 2024, BlackRock quietly retreated, exiting net zero alliances, slashing support for ESG proposals from nearly half to a fraction, and scrubbing explicit references from documents. Larry distanced himself, acknowledging the politicization had damaged trust in business. With ESG fading and passive ETFs maturing, attention shifted to infrastructure, the next frontier. Global needs demand $68 trillion by 2040 for roads, ports, hospitals, power, water, and digital networks. Unlike volatile stocks, infrastructure offers monopolistic stability. People can't bypass essential services, ensuring predictable, long-term cash flows. BlackRock's 2024 acquisition of Global Infrastructure Partners for $12.5 billion vaulted it into controlling hundreds of billions in such assets. Conflicts amplify opportunities. In Ukraine, early in the war, Larry Fink engaged directly with President Zelensky to position BlackRock as coordinator for post-war rebuilding, channeling donor funds into dedicated vehicles. Devastated regions require vast reconstruction, airports, grids, bridges, creating profitable openings. Public, catalytic capital de-risks private investment, guaranteeing returns while taxpayers shoulder hazards. BlackRock also benefits indirectly from defense holdings in index funds, profiting from tensions that precede rebuilding. The Panama Canal deal in 2025 exemplifies this. A $23 billion transaction placed strategic ports under a BlackRock-led consortium, hailed as reclaiming American influence amid geopolitical maneuvering. Yet private control of such choke points raises alarms. Maintenance may lag if unprofitable, fees could soar, and public welfare might yield to shareholder demands. Ultimately, BlackRock has transformed into an omnipresent force, profiting from conflict and peace, finance and physical assets, crisis and recovery. Whether through government partnerships, software dominance, or infrastructure conquests, it adapts to capture value relentlessly. Critics warn of eroded public accountability, skewed incentives, and risks when one firm holds such leverage over civilization's foundations. As Larry Fink continues reshaping the world, the central question lingers. In this era of concentrated power, who truly safeguards the broader interest?